Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. What a week. Let's jump in. US stock markets suffered a dramatic reversal on Tuesday, ending sharply lower after the White House confirmed that President Donald Trump would move forward with a sweeping increase in tariffs on Chinese goods. The announcement raised early optimism and triggered another wave of volatility across global markets. The benchmark S&P 500 index fell 1.6% by the close, retreating from a peak gain of 4.1% earlier in the day. The technology-heavy Nasdaq Composite slowed more than 2%. And the Nasdaq 100 remains deep in bear market territory. Tuesday marked the fourth consecutive session of violent swings on Wall Street as fears over a prolonged US-China trade war, as well as a global trade reset, have rattled investors and sent markets into a tailspin. The source of the renewed anxiety was a White House statement confirming that tariffs exceeding 100% on certain Chinese imports would go into effect just after midnight in Washington. These new duties, amounting to an additional 50%, build upon a series of retaliatory trade measures, taking the total levy above 104%, with some goods hitting 120% or higher. The market reaction was swift. Oil prices tumbled as fears of a global economic slowdown resurfaced. Crude dropped as much as 4.1% to $60.26 a barrel USD, a level not seen since the early days of the COVID-19 pandemic. The downturn in oil added to concerns that higher tariffs could choke off demand and slow global growth. The bond market offered little relief. Yields on US Treasury securities dropped as investors sought safety and bet on potential Federal Reserve rate cuts. The 2-year yield declined sharply, while the 10-year Treasury yield, which has already fallen by 40 basis points this year, continued its slide below 4%. Strategists noted that global investors are increasingly looking at alternatives to US debt, particularly as yields in Europe and Japan have risen modestly. Germany's 10 bond yield now stands at 2.66%, while Japan's has risen to around 1.25%. Making them more attractive to international buyers when adjusted for currency risk. Quote, "The 10-year yield is going vertical. Something is going to break," end quote, warned the chief market strategist at Coreplay. His comments reflect growing concerns that sustained market turmoil, compounded by aggressive trade policies, could prompt a systemic financial disruption. Equity futures suggest more pain ahead too. Contracts tracking the S&P 500 and Nasdaq 100 were down 1.5% and 1.7% respectively in early Wednesday trading, while Europe's Stoxx 600 futures fell 4.2%. The US dollar also weakened 0.6% against a basket of global currencies, reflecting reduced investor confidence in America's economic trajectory. Meanwhile, China's response has been firm. Premier Li Qiang reiterated Beijing's commitment to, quote, "fight to the end," end quote, stating that China has ample tools to, quote, "fully offset," end quote, the negative effects of US actions. As we discussed on my other channel, China Update, in today's episode, which goes up an hour after this episode, however, China is deeply vulnerable to a drawn-out trade war with the United States, with limited tools to fight back. With nearly a year's worth of stock market gains now wiped out for the S&P 500 and little clarity on the path forward, investors are bracing for continued volatility. Until there is meaningful progress on the diplomatic front, markets are likely to remain gripped by fear, or at least uncertainty, caught in the crossfire as the US resets the global trade order. Now, before we move on to Asia and Europe, where markets continue to plunge, one more US update. In a dramatic move, President Donald Trump and Defense Secretary Pete Hegseth have pledged to propose the first ever $1 trillion defense budget, a record-breaking figure aimed at bolstering US military strength. The announcement came Monday during a press event with Israeli Prime Minister Benjamin Netanyahu. Trump stated the proposed budget would be, quote, "in the vicinity," end quote, of $1 trillion, emphasizing the need for a strong military in uncertain times. Later that evening, Hegseth confirmed the plan on X, writing, quote, "coming soon, the first $1 trillion at Department of Defense budget," end quote, and vowing the funds would focus on, quote, "lethality and readiness," end quote. The proposed budget marks a major leap for the current $892 billion allocation, which funds the Pentagon, nuclear development, and other national defense programs. It also arrives ahead of the expected federal budget rollout in late May, surprising many in Washington. As part of the overhaul, Hegseth plans to cut tens of thousands of civilian Defense Department positions and consolidate both domestic and overseas bases. While Trump did not clarify if the $1 trillion applies solely to the Pentagon, national defense spending was already forecast to surpass $900 billion. Quote, "We have to be strong," end quote, Trump said on Monday, adding, quote, "Nobody's seen anything like it," end quote. Let's now move to Asian markets. If you're getting some value from today's episode of Market Update, don't forget to hit the like button. And if you want to continue to be on top of the most up-to-date news and analysis on global markets around the world, maybe consider subscribing. Hit the bell notification icon and you will be. Asian stocks plunged on Wednesday as fears of an escalating US-China trade war and volatile Wall Street trading triggered a wave of investor panic. Japan's Topix index led the regional slump, dropping 3.6% within the first 45 minutes of trading. Equity brokers in Tokyo dismissed Tuesday's brief rally as a, quote, head fake, end quote, suggesting a deeper, more sustained downturn could follow. All three of Japan's major banking groups saw their shares fall by approximately 5%, reflecting a broad-based market retreat. The yen, meanwhile, settled in the mid-145 range against the dollar after spiking overnight. In Australia, the benchmark index opened 2% lower, and the Australian dollar fell below $0.60. BHP shares dropped 4% amid renewed concerns about global iron ore demand. One trader warned that Tuesday's buyers may quickly lose confidence if the downturn continues. South Korea also faced sharp financial strain as the won, its currency, plunged to its lowest level since the 2009 global financial crisis, touching 1,487.36 per dollar. Heavy foreign selling and a weak Chinese currency added to the pressure as investors expressed unease over the country's ability to respond diplomatically to tariffs following the impeachment of former President Yoon Suk Yeol. In China, the market braced for the 104% US tariff hike, sending stocks tumbling. Hong Kong's Hang Seng Index dropped 3.2%, with its tech sub-index down over 5% at opening. Mainland China's CSI 300 slipped 1.2% at opening. The offshore currency hit an all-time low of 7.429 against the dollar, while investors fled to safety, pushing China's 10-year bond yield down to 1.65%. Meanwhile, the Association of Southeast Asian Nations will send a delegation to Washington to discuss newly imposed US tariffs that have hit the region's exports hard. Malaysia's Prime Minister Anwar Ibrahim announced on Tuesday. Speaking at an event in Kuala Lumpur, Ibrahim acknowledged limited room to challenge the motivations behind the tariffs, but emphasized the adjustments in their implementation could still be pursued. Quote, "The global trading system is under intense strain, more so than at any point in recent memory," end quote, he said. The tariffs have raised alarm throughout Southeast Asia. Countries like Vietnam and Indonesia, whose economies rely heavily on exports to the United States, are feeling the brunt of the policy. Vietnam, which has the third largest trade deficit with the United States after China and Mexico, has already taken steps to reduce tensions. The Prime Minister said Hanoi will expedite the purchase of US defense goods and commercial aircraft and has requested a 45-day delay in the implementation of tariffs. Vietnam also plans to review non-tariff barriers on US products. The impact is being felt across industries. Vietnam's fisheries sector, where over 90% of seafood is handled by local businesses, has seen shares in major exporters plunge by 25% after the announcement. The US is Vietnam's largest fishery export market, accounting for roughly 20% of sales. In Thailand, Thai Union Group, the world's top canned tuna producer, faces challenges as around 40% of its revenue comes from North America. Similarly, Vietnam's Song Hong Garment, a supplier of brands like Gap and Walmart, could see up to 80% of its sales disrupted. Indonesia, while facing lower tariff rates compared to Vietnam and China, hasn't escaped the economic fallout. The Jakarta Composite Index plunged 9% on Tuesday, triggering a trading halt. The currency dropped to a record low of 16,850 against the US dollar, prompting aggressive intervention from Indonesia's central bank to stabilize the currency. While the Association of Southeast Asian Nations delegation hopes to find common ground in Washington, the broader message is clear. Southeast Asia's export-driven model faces an existential crisis. And finally for today, with so much doom and gloom and so much heavy material, let's end on something a little bit lighter and more positive. The UK government has secured a landmark deal with Universal Destinations and Experiences to build a theme park in Bedfordshire, a project ministers are calling a vote of confidence in Britain. Prime Minister Sir Keir Starmer formally announced the agreement today, Wednesday, after months of behind-the-scenes negotiations. Expected to open in 2031, the park is projected to deliver a £50 billion boost to the UK economy, creating 20,000 construction jobs and 8,000 permanent roles across hospitality and the creative industries. Backed by US media giant Comcast, the attraction is forecast to welcome 8.5 million visitors in the first year, making it the UK's largest. Chancellor Rachel Reeves praised the investment as a signal that Britain remains a top destination for global business. The government has committed to significant infrastructure upgrades, including road and rail links, though details of the investment package remains undisclosed. The development will anchor the broader Oxford-Cambridge corridor project alongside the expansion of Luton Airport and completion of the East-West Rail line. Planning approval is expected soon, with expedited processes in place. Universal also plans to collaborate with local colleges to train a new generation of workers, cementing its long-term commitment to the region. The announcement represents a nice bright spot in an otherwise gloomy economic picture. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Don't forget to like and subscribe if you haven't already. This is a tremendous help for independent channels like this. Have a good Wednesday, or as good as one can with everything that is happening in the world today. Thank you again for watching, and I will see you all tomorrow.
Peter Zeihan here. It is April 9th. Yesterday, the Trump administration added another 50% to the tariff on China, which brings the official total to 104, and we're probably only days away from a secondary sanction being placed on China for its trade with Venezuela, which will bring it to 129%. Also, overnight, the Chinese raised their retaliation on tariffs for imports from the United States from 34% to 84%. So the largest bilateral economic relationship in human history is, for all intents and purposes, over now, and the decoupling is going to proceed with massive pace. On the American side, this is highly inflationary because there just isn't enough industrial base elsewhere on the planet, even if we had good trade relations with everyone else, to replace the manufacturing capacity that is in China. And if we're going to build it here, we need all of the raw materials, steel, aluminum, lithium, cobalt, all of it, that China is the primary processor of, and all of those now just cost twice as much. So we're looking at a minimum 10% inflation for the remainder of the year, and hyperinflation is something we need to start considering as a possibility. We're also looking at a recession because the increase in costs for the basic things that allow your life to function is now beyond the point that the lower third of the American population can afford without significant external support, and the federal government is also already in a massive debt situation that Donald Trump has promised to make worse with additional spending and tax cuts. On the Chinese side, they just lost their largest customer, their largest source of capital, their largest source of technology, and the implicit support of a country that provides the military security that allows their shipments to move. We now need to start considering what happens when the U.S. military is tasked to economic issues, which will disrupt Chinese shipping to the rest of the world, and that very quickly leads not just to a recession and a social breakdown in China, but something potentially far worse that could technically include things like military conflict, and is a disassociation of the Chinese system, and everything goes with it. This is a very quickly evolving and degrading situation. We have two cults of personality on both sides of the Pacific who basically ignore what few advisors they have left. It is now a battle of egos with the rest of us caught in the middle, and it will not end well. There is no one who can mediate here. This is no one who can talk either side down. This is going to go until something breaks. And what is going to break is the current economic expansion in the United States. We are firmly in recession territory now, and probably the Chinese system as a whole, and there's no way that those two things don't happen without a cavalcade of additional issues. Now, very soon, we're having our question time here on Patreon for subscribers. If you haven't signed in already, I suggest you do it because we're starting at 10 a.m. Mountain, noon Eastern. And for those of you who are not in Patreon, we're sending this video out to everyone so you have some idea of what's coming down the pipe. We're going to be answering questions for a good long time. I'm going to do my best to be ready for everything you've got. Sign up links are at the end of this video. See you soon.
Happy Wednesday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. I know I said that we would be taking Wednesday off, but with this week, that was never going to happen. Let's jump in. The United States has dramatically escalated its trade war with China by imposing a new wave of tariffs. The Trump administration has added a 50% increase on a wide range of goods imported from the People's Republic of China, with even steeper penalties announced shortly after. At noon Eastern Time on Tuesday, the 104% tariff came into effect, according to a statement from the White House press secretary, in response to what Washington views as continued retaliation by Beijing. Starting Wednesday, today, these 104% tariffs, as well as higher rates, will be collected, intensifying the already historic levels of economic pressure between the two nations. In a related executive order released late on Tuesday, the administration also raised the so-called de minimis tariff from 30% to 90%, aiming to prevent importers from circumventing the new levies through loopholes. Taken together, tariffs on many Chinese goods now approach or exceed 120%. This marks a critical inflection point in the US-China trade relationship. Analysts warn that without a negotiated retreat, the current measures could trigger a major decoupling between the world's two largest economies, with ripple effects felt across global supply chains. US Treasury Secretary Scott Bessent called China's latest escalation a, quote, big mistake, end quote, stating that, quote, they are playing with a pair of twos, end quote, making a poker analogy. Bessent emphasized the imbalance in the trade exposure, noting that the United States exports far less to China than it imports. In 2024, China exported over $500 billion to the United States. Despite outreach to other nations like Japan and South Korea, Beijing has shown no indication of re-engaging in trade talks. On the Chinese side, tensions remain high. General Secretary Xi Jinping has not made a public appearance since early April, though reports suggest key meetings may be underway. His past visits to rare earth facilities have been interpreted as signaling potential export restrictions, a move that could escalate tensions further. Meanwhile, Beijing finds itself with limited retaliatory options. Chinese advisors privately admit that surrender would be seen as weakness, but note that few viable alternatives exist. Many traditional export markets are saturated or wary of Chinese goods. Efforts to diversify toward Southeast Asia and Europe have had very limited success, especially as global economic growth slows. Regular viewers of China Update will know that China is grappling with several structural issues within its economy, one of the key ones being chronic overcapacity. You'll know too that exports for the last few years have been one of the few areas of healthy growth in the economy, and now they have likely lost access to their biggest export market. Now, while many in Beijing recognize this privately, publicly, official responses from Beijing indicate no intention to de-escalate. Chinese authorities and influential voices across media and academia have firmly rejected any suggestion of backing down, framing the latest tariff threats as aggressive and reckless. The Ministry of Foreign Affairs was unequivocal. Quote, if the US decides not to care about the interests of the US itself, China and the rest of the world, China's response will continue to the end, end quote. Echoing the defiance, the Ministry of Commerce declared that, quote, China will resolutely implement countermeasures, end quote, if the US proceeds, describing the move as further evidence of American intimidation tactics. Experts within China are also advising caution against early negotiations. Wu Xinbo of Fudan University in Shanghai noted that many in Beijing believe it would be unwise to seek talks now, expressing today, quote, some people here believe that we should not seek negotiations right away. Eventually, Trump will be under a ton of pressure and is maybe willing to negotiate with China, and by then, China will be in a better position to bargain. If we offer to negotiate right now, that plays into Trump's hands, end quote. Meanwhile, potential retaliatory measures are being circulated widely online. Suggestions include suspending cooperation on fentanyl, slashing agricultural imports from the US, and targeting sectors such as IP revenues and services. While unofficial, the traction these ideas have gained indicates a public and policymaker appetite for firm responses. It's even been suggested that Beijing ban American films. As a side note, US films have been limited in China for many years, one of the many non-tariff barriers Beijing has erected against the US, which the US administration is now seeking to respond to. Prominent Chinese commentator Min Jinwei has called for even bolder actions, pivoting to yuan-based trade, here referring to the Chinese currency, reducing US debt holdings, and even stepping up military posture. Quote, "It rains when heaven deems fit," end quote, Min wrote, quoting an old Chinese saying, adding, quote, "All China can do is respond actively," end quote. With the tariff hike now set to take effect, the battle lines have hardened. Neither side shows signs of retreat, and the global consequences of this deepening trade war may soon be felt far beyond Washington and Beijing. We are currently living through a turning point in history. If you want to follow all the relevant developments as they happen every day, maybe consider subscribing to China Update, and you will be on top of the most up-to-date news and analysis as it happens. If you're getting some value from today's episode, don't forget to hit the like button, and if you would like to support independent YouTube channels like this is a one-man band. I write, film, edit, upload, and manage everything, and I rely primarily on subscriber support. Patreon and Buy Me a Coffee links are in the description below. Chinese markets plunged on Wednesday morning as investors reacted to the tariff escalation news. Hong Kong's Hang Seng Index sank 3.2% shortly after opening, while the Hang Seng Technology Index plummeted 5.42%. Mainland shares also suffered, with the CSI 300 index falling 1.2%. Interestingly, soon after this initial opening drop, Beijing signaled support for technology firms, fueling a slight reversal of some of these losses. Currency markets also reflected growing anxiety. The offshore renminbi dropped to an all-time low of 7.4242 per US dollar, while the onshore yuan midpoint was set by the People's Bank of China at 7.2038, its weakest level since 2023. The central bank has now allowed the yuan to weaken for 5 consecutive days, a move seen by analysts as an effort to ease the economic blow from the US tariffs. China's 10-year benchmark yield dipped to 1.65% as investors sought safety in government bonds. The broader market shift suggests growing concerns over capital flight and further trade turbulence. Goldman Sachs noted that while the Chinese government still prioritizes foreign exchange stability, its current strategy appears focused on managing the pace of depreciation rather than targeting a fixed exchange rate. Analysts warn that a continued drop in the currency could disrupt global trade, potentially triggering competitive devaluations by other economies and further escalating tensions with Washington. However, with tariffs now over 100%, Beijing cannot devalue its way out of this problem without crippling its own economy. Economic models from Goldman Sachs released yesterday project that new 50% tariffs could shave nearly an additional full percentage point off China's 2025 GDP growth. The impact of these tariffs layered on top of those from previous administrations, as well as the earlier Liberation Day tariffs, now threaten to upend a trade relationship that has long served as a stabilizing force between Washington and Beijing, and plunge China into a much deeper economic crisis. Now, for part 3 of today's video, let's move now to Europe. European Commission President Ursula von der Leyen and Chinese Premier Li Qiang held a high-level phone call on Tuesday, addressing growing concerns over US tariff policies and their global impact. According to the Chinese government's readout, Premier Li criticized Washington's, quote, tariff abuse, end quote, calling it a, quote, typical act of unilateralism, protectionism, and economic bullying, end quote. He stressed China's determination to defend its development interests and international trade norms, while reaffirming Beijing's commitment to continued opening up and cooperation with global partners, including the EU. The readout also quotes von der Leyen as expressing similar disapproval of US actions, stating that the tariffs, quote, have seriously impacted international trade, end quote, and harmed both the EU and China. However, the European Commission's own account struck a much more nuanced tone. Von der Leyen emphasized the need for, quote, a negotiated resolution, end quote, to prevent further escalation, and stressed Europe and China's shared responsibility to uphold a fair, rules-based trading system. She also highlighted concerns over possible trade diversion stemming from the tariffs, particularly in sectors burdened by overcapacity. The two leaders discussed establishing a mechanism to monitor such shifts and ensure proactive responses. While China may hope to rally the EU into a united front against the US, the diplomatic reality appears more cautious. European officials are increasingly wary of becoming an inadvertent dumping ground for Chinese exports displaced by US tariffs. The EU recently announced a new task force to monitor trade diversion and has hinted at safeguard measures should China fail to cooperate. While some commentators around the world argue that US tariffs will push the EU and China closer together, the fact of the matter is, the EU for years has already been concerned with Chinese overcapacity, accusations of dumping in Europe, and, on top of that, the US market is far bigger than China's. Both the EU and China need countries to sell to, and neither can replace the size or dynamism of the US consumer market. And further complicating the picture, Ukrainian President Zelensky revealed yesterday, Tuesday, that 2 Chinese nationals were captured fighting alongside Russian forces. It's reported that the 2 Chinese fighters, aged 33 and 31, had both been recruited by Russian military officials to sign up as contract soldiers. This would mark the first confirmed instance of Chinese citizens participating in combat against Ukraine, risking further strain on Beijing's relations with Europe. Veteran China analyst Bill Bishop observed on The Development today, quote, "There is no evidence so far that they are anything more than mercenaries, and some PRC citizens have fought for Ukraine. But obviously, any possibility that the PRC has sent troops to help the Russians would be a massive problem. But I am skeptical Beijing would be that reckless and stupid." End quote. Okay, that is today's episode of China Update. If you appreciated this extra episode, don't forget to hit the like button. I hope you got some value from it. This week is going to be a busy week. There will definitely be another episode tomorrow. Make sure you're subscribed so you get that when it's released. Thank you again for watching. Have a good Wednesday, and I will see you all for another episode tomorrow.